Now, just to kind of bridge some of the gaps of the things that we've been talking about, here's one with the concentrated risk when we look at commercial real estate loans as a share of net loans and leases. And you can see that banks with less than $100 billion in assets is taking some of the largest share of that, which is why when we look at some of the smaller regionals or regional banks, you can consider that they have some more exposure to their local region. So it'll be interesting to see how much of that can be backstopped, if there can be some rejuvenation in terms of just getting some fresh capital. But this is going to be something to watch as we start to look at maybe some pain, especially on a municipal level, where we could see municipalities needing new cash or new inflows. Who owns the debt? What does that local bank look like? Because typically if the municipality is struggling, they're struggling with tax revenue, which means that some of these loans might have gone belly up or in arrears, which again, all of that means is there's just going to be more bad debt expense. And if there's more bad debt expense, there's going to be more pressure, which just means that those banks won't be able to lend. Even if they have a high cash count at the bank itself, they need that to shore up and to provide collateral for some of those, that debt, which again is why we continue to see this bottleneck, which if you go to our US dollar show, we start talking about the Cantillon effect, what is happening in terms of getting some of these dollars through the system and why there's that bottleneck within the bank. Now, when we look at retail sales, we want to look at it seasonally adjusted across the globe. And the reason why we want to do that is because we've talked about in the past how retail sales, and obviously this is through the end of August, which they've slowed down a bit in the US and the EU, but they're still over where they were, is China. So China and Japan, we've seen that drop, but we keep highlighting how the Chinese consumer continues to struggle. And when you think of the wealthier Chinese individual, they typically purchase foreign products, and we've seen those imports continue to surprise to the downside or continue to be very lackluster. And just when we look at travel, there's been a big drop off in terms of travel outside of the country. And we're starting to see travel slow down in terms of Golden Week. Now, we'll get official data. Question is like how trustworthy it is. So far it's about 20% below last year. And if you consider where we were on just some of this data ahead of Golden Week, that would make sense. We've seen the slowdown. We've seen the seasonally adjusted base where we're just not getting to where the local consumer continues to be a problem. And when we talked about the Asian culture in specific countries where saving is a priority in a lot of these areas, and they've tried to change that and try to get the local consumer to be stronger. Now, China's also saddled a lot of their residents with additional debt. So it's not just grown at the corporate level, the government level, at the provincial level, but also at the consumer level. And as you have additional pressure with just where exports going, how are things flowing, this is really kind of indicating where there's going to be a longer term problem, especially when you start looking out at, as we talked about in the second segment, or tying into the first segment, when we had pressure in the Yangtze River economic basin, and now we're seeing that pressure continue to develop at the level of exports, where the consumer just isn't there, the exports aren't there, and this is why we're seeing that slowdown in those Chinese daily activity numbers. Now, one of the ones that we pulled out and we talked about in the past was German truck miles, which is calculated by tolls, is continue to stall. So we had a nice rally off the bottom. We essentially went straight up, which if you look at how the US has done, it's very similar, where there's a huge amount of trucking miles being logged just based on where the flow is. But it's slowing. And this is why, again, coming to the idea of we're hitting this plateau and we're starting to roll back over. And if you want to talk about how Europe in general is slowing, Germany is a huge exporting, powerhouse. And if they can't export to the region and or other places, this is kind of indicative of where those headwinds are starting to shape, which is why this has been a very good leading indicator to, we're starting to see some of that slowdown. So if we saw the slowdown through September, that will start to appear in October, and we're starting to see some of those impacts. Now, while this is a hard data point, another good data point has been, what is manufacturing sentiment? What do people think is going to happen? And it has been a fairly good indicator. Now, if you look back in 2018, it's still, even though it was an indicator of growth, it's still underestimated. And I think that we're starting to, I think that is starting to come more into play, where if you layer in toll miles, if you layer in exports, if you layer in resurgence of COVID in France, UK, Spain, new issues with some of their trade partners, we'll get growth. That's likely year over year. Factory orders will either be slightly expansionary or right at that level, because it will follow the trend. It just won't. I just don't think it's going to hit that high note, especially when we have those toll miles telling a story, PMIs telling a story, and the inherent export data telling that story. And that's why when we look to, where did it come into? And when I say not telling that story, construction PMI slowed down in Germany to 45.5. So even though we had some growth in the PMI, as we talked about getting into that mid 50s, servicers underperformed, construction underperformed. And by construction underperforming, that just means that there's going to be maybe a little bit less movement on the trucking side, a little bit less pull through of raw materials, whether that be cement, sand, steel, lumber. Those are things that are going to be those headwinds, which is why I have relative confidence in saying that, yes, sentiment is getting better. It's indicative of something that is going to pull it higher. It's just not going to get to where it should, and it's going to underperform. And that's why when we look at just the industrial production, you can see that when we look at manufacturing orders year over year, they're getting better. They're coming hard off the bottom, but again, they're hitting that plateau. They surprised a little bit to the downside versus estimates, and then the industrial production continues to hit that plateau that we keep talking about and we keep identifying in daily activity. And these are those data points. These are the data points that continue to show, like, look, things have gotten better, but we're slowing. We're not getting over that hump. And as we look at, well, how are companies going to stimulate and invest? And it's going to take time, and that's why this is going to be that long drawn out recovery as we get this issue with just jobs and just general spending, where the government won't be able to stimulate its way out of it because we just don't have that job growth. And just because we're talking about Germany, it's important to look at France and that budget balance, because the balance sheet continues to get worse. And now, not to say that France can't go out and borrow it, because they can. It's just the deficit is growing, and if we go back to the beginning when we talked about pulling some of that growth forward by issuing a ton of debt, essentially, layering and minimizing the future growth of different countries. This is just an example, is because the stimulus is being pushed out so much, and they have to close this gap, which is, again, may help stave off a depression or a steeper downturn, but you're essentially capping some of this future growth, which is going to be problematic as we go through the years, unless we get a brand new industry created and all of a sudden things are back to normal. But again, it's just look at the pace, look at the growth, and just look at, this is the worst it's been since at least 2014, which again is going to be problematic. So when we look at Germany, when we look at Germany, China, South Korea, Japan, the US, like, these are key areas in terms of some of the largest countries in the world, largest economies in the world, I should say. And they're just hitting along this struggling path, which is why we think that just inherent oil demand, diesel demand, gasoline demand, jet fuel is going to struggle to get there, especially with the amount of supply that's sitting behind either artificial walls of agreements with OPEC or just political in terms of sanctions or something else, which is something that we're going to go through a bit more detail in our OPEC show. So thanks again for watching. Coming up this week, we're going to have our primary vision frac spread count, which I know everyone's excited about. Hopefully we get another growth, just to see some people getting back to work. And for that show, we're going to talk about some of this jobs data that was very interesting coming out of Deloitte, which was relatively unique. And then we're going to have an OPEC recap in terms of supply demand, as we talked about, because that's going to be a bigger driver in terms of some of that supply that can come online fairly quickly, especially with the shortage of dollars that they have on their balance sheet. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.